Good morning. My name's Charlie Aitken. Last five trading weeks of the year coming up, and I think it's going to be more of the same for the Australian equity market. Remembering the Australian equity market's broadly flat this year. When you include dividends, we're up about 4%, but the ASX 200 measured as a capital market has really gone sideways. But inside that, there have been opportunities to make money. It's all been about stock selection and trying to make the macro fit the micro this year. And really, if you've got the direction of commodity prices right and you've got the direction of the Australian dollar right, you've got everything right. Because interest rate expectations, yield expectations, commodity earnings, the Australian dollar, US dollar earnings, all were related to that call. And I see that continuing. Everything is about a resurgent US dollar. The American economy looks better than all other economies, particularly Europe. Money is flowing back to the US dollar, and that is underpinning a fall in commodity prices and the outperformance of all things American. That will continue. American GDP growth is running at about 3.5%, the rest of the world at 1.5% to 2%, even worse in Europe. And I think the outperformance of America will continue and the outperformance of the US dollar will continue. On the other side of that, commodity prices continue to fall on the fact that the US dollar is strong and supply is arriving in all commodities. The supply response arriving at the same time as the US dollar falling has caused very sharp falls in commodity prices, but to still what are high commodity prices. And I think that the downgrade cycle in commodities and mining services stocks and energy stocks will continue, and they will continue to underperform the market. Quite frankly, it is almost impossible to make money in a mining or energy stock when the underlying commodity is falling, and that also applies to mining services and oil services stocks when the underlying commodity is falling. I think that that will continue, and I think the Australian dollar will continue to fall. I'm predicting the Australian dollar to have a 7 in front of it early next year. We need that to happen for the Australian economy to rebalance aggressively. We need it for inbound tourism. We need it for our commodity prices to be appropriately priced and competitive globally. But outside of that, all this is leading to interest rate expectations in Australia changing to the downside. The market is now assuming via 3-year bond yields that there is a chance of interest rates being cut in Australia next year. I think that is right, and I think that those interest rate expectation changes will have ramifications for Australian stock selection. Yield stocks will outperform into the end of the year. You will see the banks, Telstra, Wesfarmers, infrastructure stocks, anything with a decent dividend yield outperform at the expense of mining and energy stocks. And I think you'll see the Aussie dollar continue to fall and US dollar earnings stocks continue to rise. The US dollar earnings stocks I like are Westfield, Crown, QBE, ResMed and Brambles. They would be my top 5. The yield stocks I like are ANZ, NAB, Telstra, Transurban, Wesfarmers, IAG, and I recently upgraded Challenger as well, a stock I think is going to a 5% yield as the world gets more enamoured with annuities in a volatile period. Outside of that, the one trade I do like in the short term into Christmas is discretionary retailers, selected discretionary retailers. I think Australians are in a position to open their wallets this Christmas with house prices at record highs and generally the employment situation okay, interest rates at all-time lows. I particularly like electronic goods for the Apple effect, and I think JB Hi-Fi is well positioned. In recreational and sporting goods, I like Supercheap Auto and RCG Group. And I also think Australians are in a good position to buy new cars with new car affordability at 27-year lows, which is good for the prospects of new car sales. So I like Automotive Holdings, Australia's biggest retailer of cars. Outside of that, as I mentioned before, I think it's going to be more of the same. I think the market will edge up 100 or so points into Christmas. I wouldn't be surprised to see the ASX 200 around 5,500 at the end of the year. That'd be a moderate result, okay, when you include dividends. But in US dollars, we're down, and the biggest outperformance you could have generated this year was actually investing as an Australian investor in US equities in US dollars. That will probably continue, and I continue to recommend some of the bigger fund managers who have US dollar funds in Platinum and Magellan. They will continue to outperform. But all in all, another point worth making is that a lot of the outperformance this year has come from initial public offerings. If you'd simply supported the IPO flow this year, you would have done very well, and that includes Medibank. And I expect that to continue in the new year. But generally, into the end of the year, more of the same with a trading emphasis on discretionary.